Stop what you're doing right now, this second. Put down the coffee, pause that video, silence your phone, close the trading app before it does something you regret. And for the love of your future self, stop scrolling like everything is normal, because it is not. One of these screens is about to lie to you, and yes, she will never match you back either, so focus. Are we clear? Good. If you own silver, do not sell a single ounce. Do not place a single order. Do not panic click anything until after you finish this video, because what is happening in the silver market right now is not a dip, not a pullback, not healthy consolidation. It is a flashing red warning siren that most people will ignore right up until the moment it's too late. Ladies and gentlemen, this is Paper to Atoms. It is 31 Jan 2026, and I'm about to tell you something that Wall Street insists is impossible. Yesterday, 30 Jan 2026, we talked about stress building under the surface of the silver market. We talked about the widening gap between paper prices and physical demand. We talked about the sudden surge in Eastern buying while Western traders were busy shorting the rally like nothing had changed, and I told you that the market was coiled, tight, unstable, ready to move violently the moment pressure hit the wrong spot. I told you the price action did not match the fundamentals. I told you inventories were being drained while the charts looked calm. I told you that when paper and physical disconnect, the snapback is never gentle. And you know what happened? Silver got hit hard in overnight trading. But physical premiums did not fall. They rose. Let that sink in. The futures price dipped. The headlines said metals cooling. Analysts on financial TV nodded like this was all perfectly normal. But behind the scenes, the actual metal, the real, tangible, deliverable silver, got tighter. Dealers reported delays. Large orders did not get cheaper. In some cases, they got more expensive. That is not how a healthy market behaves. Normally, when price drops, supply loosens. Sellers appear, premiums fall. Inventory builds. That is the textbook. That is the model. That is what the spreadsheets say should happen. But yesterday, the opposite started to unfold. And today, it escalated. Because what looked like a routine pullback on a chart is now revealing itself as something much more dangerous. A stress fracture in the pricing system itself. And this is where it gets really interesting. Because the same forces we discussed yesterday, the same inventory drain, the same east-west split, the same aggressive paper selling, just collided all at once. Here is the core development you need to understand, and you need to understand it clearly. Silver futures in New York just printed $68.42 on a sharp intraday drop, while at the exact same time, large wholesale physical orders in Asia are being quoted at the equivalent of $74 to $76 per ounce after premiums. The same metal, the same day, the same global market, the same ounce of silver is being valued almost $8 apart, depending on whether it is a paper contract or real deliverable metal. In a functioning market, this is impossible. Prices across major financial centers are supposed to stay aligned through arbitrage. If silver is cheaper in one place, traders buy it there, ship it, sell it where it is higher, and the gap closes. That is Markets 101. That is how commodities have worked for over a century, but that mechanism is failing right in front of us. The same silver, the same 1,000-ounce bars, the same global supply chain. And yet the pricing is splitting into two different realities. One price for paper promises, another price for actual metal you can hold. That tells us something is breaking beneath the surface. And I am going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Yesterday's COMEX silver close, $71.83, overnight low in futures trading, $68.42. That is a 341 drop in less than one trading session. Now in a normal market, that kind of move would shake loose supply, weekends sell, dealers get metal offered to them, premiums fall, inventories stabilize. But here is what happened instead. Major US online bullion dealers this morning were listing 1-ounce silver coins at the equivalent of $77 to $80 per ounce after premiums. Not yesterday. Today, while the screen price was under 70. Let me say that again so it sinks in. The paper market said $68. The physical retail market said nearly $80. That is a $12 spread between what the screen tells you silver is worth and what you actually have to pay to get it in your hand. That is not friction. That is not normal premium expansion. That is a pricing fracture. Now let us go bigger than retail. Wholesale 1,000-ounce bar indications coming out of Asia overnight, particularly tied to Shanghai Futures Exchange pricing, were translating to roughly $74 to $76 per ounce when converted to dollars and adjusted for local premiums. So now we have three prices. COMEX futures, $68.42 US retail physical, $78 Asian wholesale physical, $75 the same metal. 3 different realities. That is a 10% to 15% premium for real, deliverable silver over paper contracts. In a properly functioning global commodity market, that spread would get crushed in hours. Traders would buy the cheap futures, stand for delivery, ship bars to where demand is higher, and pocket the difference. But that is not happening, and this is where it gets really interesting. COMEX registered silver inventories, the category that is actually available for delivery, have been trending down for months. Recent warehouse reports showed another multi-million ounce decline just this week. Metal is leaving the exchange system, not entering it. At the same time, open interest in silver futures remains massive relative to the amount of registered metal. That means there are many more paper claims than there are ounces readily available to deliver. So while price dropped 4.7%, available deliverable supply did not rise. It fell. That is backwards. Now let us look at spreads. The March to May futures spread widened sharply during the drop, signaling stress in near-term supply. Normally, when price falls, near-term contracts get cheaper relative to later months because there is no rush for metal. Instead, the front month held firm while the back months softened. That tells you something very simple. People want silver now, not promises later. Let me say that again. They want silver now, not next quarter, not next year. Now, and here is the kicker. Gold did not fall nearly as hard during the same window. The gold-silver ratio spiked violently as silver was hit with aggressive paper selling. That kind of ratio move typically happens when silver is being used as the pressure valve, the market where large players can push price around with fewer dollars. So what do we have? Price down, physical premiums up, exchange inventories down, all at the same time. That is a trifecta of stress. In normal corrections, price falls because supply overwhelms demand. Metal flows back into the system. Premiums compress, inventories build. Here, price fell because paper contracts were dumped, while the real-world metal kept getting drained. That is not a healthy market. That is a market where the pricing mechanism is being forced in one direction, while the physical reality is pulling hard in the other. And when those two forces separate too far, something gives. Either physical premiums collapse, or paper prices snap violently higher, or the exchange changes the rules. ETH X has happened. Paper silver was smashed. Y has happened. Physical silver got tighter. Z has happened. The spread between them exploded. That combination is rare, dangerous, unstable. And this is why today's drop is not bearish. It is a warning flare. Now let me put this in perspective because I do not want you to think I'm exaggerating. We have seen volatility in silver before. We have seen spikes, crashes, squeezes, and panics. But what we are witnessing right now is structurally different. In 1980, during the Hunt Brothers episode, silver exploded higher because physical demand overwhelmed supply. Prices surged, yes, but the pricing mechanism still reflected real-world tightness. Futures and physical moved together, violently, but together. In 2008, during the financial crisis, silver crashed as liquidity evaporated. Funds sold whatever they could. Margin calls hit. But again, paper and physical largely fell in sync. Premiums rose for a while due to logistics, but the core pricing structure did not fracture like this. In 2011, during the Silver Sunday margin hikes, we saw a coordinated effort to cool an overheated market. Prices were slammed, volatility was crushed, but even then, the arbitrage system, the mechanism that keeps global prices aligned, still functioned. If there was a spread, traders could close it. But today, in a normal market, if silver is $68 in New York and $75 in Asia, traders buy in New York, ship to Asia, sell, and the gap closes. But today, that is not happening. The arbitrage is dead. Not difficult, not expensive, dead. And that should scare anyone who understands how commodity markets are supposed to function. Let me walk you through why. Can we not ship silver from the US to Asia? Of course we can. Planes fly, ships sail, logistics companies exist, so transportation is not the real barrier. Can we not insure it? Of course we can. Precious metals have been moving across oceans for centuries. Insurance markets are deep. Can we not find buyers? Clearly not the issue. Asian demand right now is strong and persistent, so that is not the problem. The problem is availability and trust. The kind of silver that satisfies exchange delivery requirements, large, good delivery bars, is not sitting around in unlimited quantities waiting to be scooped up at depressed paper prices. Much of it is already spoken for, leased, encumbered, or sitting in long-term holdings that are not coming back to market just because a futures contract dipped. At the same time, standing for delivery on futures is no longer seen as a simple, risk-free arbitrage by many large players. There is counterparty risk, there is rule change risk, there is timing risk. If you cannot be absolutely certain you will get metal when you demand it, that spread is not free money. It is a gamble. And serious money does not gamble on delivery when stress is rising. It steps back. So the natural shock absorber of the market, arbitrage, freezes. And when arbitrage freezes, price discovery breaks. That is what we are seeing. In a normal market, price tells you where supply and demand meet. But when the paper market can be pushed around with leverage while the physical market runs on actual metal changing hands, those two worlds can drift apart. Paper says one thing, reality says another. And the longer that divergence lasts, the more unstable the system becomes. Because eventually, one side has to give. Either physical demand collapses and premiums crash, which is not what current buying patterns suggest, or paper prices have to rise violently to reconnect with physical reality. There is a third option, of course. The rules change. We have seen it before. Position limits, margin hikes, trading halts, cash settlement incentives. All of these tools exist, and all of them have been used in past episodes of extreme stress. But every time that happens, confidence erodes a little more. And confidence is the foundation of paper markets. Let me ask you something. If the quoted price of silver falls, but you cannot buy meaningful quantities anywhere near that price, is that really the price? If inventories are draining while charts look calm, is that really stability? If the mechanism designed to keep global prices aligned stops functioning, is that really a healthy market? Of course not. This is why what we are seeing is unprecedented in the modern silver market structure. Price down, physical tight, arbitrage frozen. That combination does not resolve gently. It resolves with force. And now, on top of all of that structural stress, something else happened behind the scenes that poured gasoline on the fire. Now let me tell you what happened this morning that makes today's move even more significant. Right as silver was trying to stabilize after the initial overnight drop, margin requirements on key silver futures contracts were quietly raised at the exchange level. Not dramatically, not with flashing red headlines, just enough. They did this specifically to increase the cost of holding long positions. They did this specifically to pressure leveraged traders. They did this specifically to slow down upward momentum and shake out weak hands. And who benefits when leveraged longs are forced to sell into a falling market? The large institutions that are structurally short, banks with deep pockets, banks with access, banks who can withstand volatility far longer than a retail trader or a small fund ever could. For years, traders have pointed to concentrated short positions held by major bullion banks, names like JP Morgan, HSBC, Bank of America, institutions that operate both in the physical market and the derivatives market, institutions that can hedge, roll, and reposition in ways smaller players simply cannot. Now, to be clear, exchanges like the CME say margin adjustments are about risk management and volatility control. And on the surface, that sounds reasonable. But timing matters. Raising margins into weakness increases selling pressure. It forces liquidation, it accelerates downside moves, and that can create the exact price drop needed to relieve stress on large short positions. They did this to cool the market, they did this to cap the rally, they did this to protect the banks who are short, and for about an hour, it looked like it might work. Silver dropped fast, stops were triggered, momentum algos piled on, financial media headlines started using words like correction and profit taking, but then something happened. Physical bids did not disappear, Asian markets kept buying, premiums did not collapse. Instead of triggering a cascade of real-world selling, the paper smash ran into a wall of stubborn, persistent physical demand. We have seen this movie before. Think back to 2011. Silver Sunday. A series of rapid-fire margin hikes hit the market just as silver was surging toward $50. The effect was immediate, violent. Prices were slammed lower in days. But that was a different environment. Inventories were higher. Retail participation was extreme. The rally had gone parabolic. Today, the setup is quieter but more dangerous. Back then, the goal was to pop a speculative bubble. Today, the goal appears to be containing a structural shortage. That is a much harder problem to solve. Because you can scare speculators out of paper contracts. You cannot scare industrial users out of needing silver for electronics, solar panels, medical equipment, and defense systems. You cannot scare long-term stackers into suddenly trusting a system they already distrust. You cannot margin call a solar manufacturer's production line. So the paper side can be pushed down with leverage and rule changes for a while. But if the physical side keeps absorbing metal, the pressure just builds elsewhere. And this is where it gets really interesting. After the margin news hit and silver dipped again, volume spiked, but open interest did not collapse the way you would expect in a true liquidation event. That suggests new shorts were entering as others were forced out. In other words, fresh paper supply was created to meet selling pressure. That can suppress price in the short term, but every new short is a future buyer. Every contract sold has to be bought back or delivered against. And if confidence in delivery is fading while physical inventories are draining, those short positions become a ticking clock. The exchange can change margin rules. They can change position limits. They can encourage cash settlement. They can do all of that, but they cannot print silver. And that is the villain's weakness. Because the more they lean on paper tools to control price, the more obvious the disconnect becomes between the digital number on a screen and the metal people are scrambling to secure in the real world. And when enough participants realize that difference matters more than the quote, control starts to slip. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. In Shanghai, gold futures held firm while silver dipped in New York. That divergence matters. Chinese traders tend to be far more sensitive to physical availability than to Western paper flows. When they keep bidding for metal into weakness elsewhere, it signals underlying demand that is not speculative. It is strategic. And premiums in Asia reflect that. Wholesale desk chatter overnight pointed to continued strength in physical silver bids across major hubs, even as Western screens flashed red. People in that region were not reacting to a falling chart. They were reacting to supply risk. In India, dealer premiums on silver products have also stayed elevated despite global price volatility. India is one of the world's largest silver importers, especially for jewelry and investment bars. When local buyers step in on dips instead of backing away, that tells you the lower paper price is being seen as an opportunity, not a warning. In the West, meanwhile, something else is cracking. The bond market has been under renewed pressure. Yields on longer-dated government debt have been climbing again, signaling stress in sovereign financing and expectations of persistent inflation. Rising yields mean tighter financial conditions, which usually hurt speculative assets. But here's the twist. Precious metals are not behaving like pure speculation. Gold has been relatively resilient. Silver's paper price is volatile, yes, but physical demand has not folded the way a true risk-off liquidation would suggest. That tells you metals are being treated not just as trades, but as insurance. And then we have industrial demand. Silver is not just a monetary metal. It is critical in solar panels, electronics, EV components, medical applications. Major manufacturers do not care about short-term chart patterns if they need material to keep production lines running. Reports over the past year have pointed to tightening silver supply in the industrial pipeline, particularly for high-purity forms. When futures prices dip, procurement departments often use that as a chance to lock in supply, not to back away. So while paper traders in New York were hitting the sell button, industrial users globally were likely looking at the same move and thinking, buy. In Shanghai, physical bids steady. In India, premiums elevated. In the West, bonds wobbling, inflation fears lingering. These are not isolated data points. They are interconnected signals. Because when financial assets start to look fragile and real-world supply chains start to look tight, capital rotates. Quietly at first, then all at once. And this is why the silver story cannot be viewed in isolation. Gold strength limits how far silver can be pushed before relative value buyers step in. Bond market stress increases the appeal of hard assets. Emerging market demand provides a constant physical drain that does not care about Western derivative games. So even as paper silver gets smashed in one time zone, the rest of the world is reacting in ways that tighten, not loosen, the physical market. That is a dangerous imbalance, because global commodity markets are like interconnected pressure systems. You can push down in one area, but the pressure pops up somewhere else. Right now, that pressure is showing up in physical premiums, in regional price differences, and in persistent buying outside the paper trading centers. And this is where the trap is set for anyone who thinks the number on their screen tells the whole story. Now let me tell you about the 60/80 trap, because that number on your screen right now, that flashing red quote that says silver is cheap, silver is falling, silver is weak, that number is a paper price, a derivatives price, a price discovered in a leveraged arena where contracts change hands by the thousands and almost none of them ever result in metal moving. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. They are not the same thing anymore. Pick up your phone right now. Seriously, call your local bullion dealer. Ask them to sell you meaningful quantities of physical silver at $68.42 per ounce. They will laugh at you, not because they are greedy, not because they are confused, but because they cannot replace that metal anywhere near that price once it leaves their shelf. Dealers price off futures, yes, but they also price off replacement cost and availability. If their suppliers are charging higher premiums, if delivery times are stretching, if wholesale inventories are tight, retail prices stay elevated no matter what the paper market does for a few hours. So you end up with this surreal situation. The chart says silver crashed. Your dealer says silver is still expensive. Both are correct in their own systems. This is the decoupling. This is the moment where the paper market and the physical market snap apart. For decades, futures prices and physical prices moved closely together. Small premiums, small discounts, nothing dramatic. The futures market was the tail that wagged the dog, and the physical market followed. But when stress builds, that relationship flips. The physical market becomes the dog. The paper market becomes the tail, thrashing around volatile, increasingly disconnected from the real flow of metal. And this is the lie. The lie is that the futures price is the truth. The lie is that a red candle on a chart means silver is suddenly abundant. The lie is that you can always convert paper exposure into real metal at will. In calm times, those assumptions feel safe. In stressed times, they become dangerous. Because if you base your decisions purely on the screen price, you might sell real metal into a paper-driven dip, only to watch premiums explode and availability vanish days later. You might think, I'll just buy back cheaper. But cheaper where? On a chart? Or in the real world where dealers are sold out, waiting lists are growing, and premiums have doubled? That is how people get trapped. They trade a tangible asset for a number on a screen. And when they try to reverse the trade, the bridge between those two worlds is gone. Let me say that again. The trap is believing paper price equals physical value. When those two diverge, the futures market can look weak at the exact moment the physical market is screaming tightness. And the wider that gap gets, the more unstable the system becomes. Because eventually either physical demand collapses and premiums crash, or the paper market is forced to reprice violently to reconnect with reality. Historically, when decouplings happen under conditions of strong demand and falling inventories, the resolution is not a gentle drift lower. It is a sharp, chaotic move higher that catches almost everyone off guard. That is why the 68 number is not comfort. It is a warning. So what does this mean for you? What should you do right now? Let me be very clear. First, if you own physical silver, coins, bars, rounds, anything you can hold in your hand, do not sell. Do not even think about selling. A paper-driven dip in futures price does not magically create more metal in the real world. If anything, these events often tighten supply further as strong hands absorb what weak hands let go. If you already navigated the premiums, the delays, the effort to secure physical, this is not the moment to hand it back because of a red candle on a screen. Second, if you own silver ETFs like SLV or PSLV, you need to seriously consider your risk. ETFs trade like stocks. They are liquid, convenient, easy to buy and sell, but they are still paper vehicles tied into the financial system. They depend on custodians, counterparties, market makers, and in some cases, complex structures that most investors never read about. In calm markets, that structure feels fine. In stressed markets, you have to ask yourself a hard question. Do you trust the plumbing of the financial system more than you trust metal in your own possession? That is not a command. That is a risk assessment you need to make with open eyes. Third, if you trade silver futures, you need to decide right now whether you trust the exchange to deliver if things get tight. Futures are powerful tools. They offer leverage, liquidity, and flexibility, but they are also governed by exchange rules that can change. Margin requirements can rise, position limits can shift, cash settlement can be encouraged, delivery procedures can be modified. If your strategy depends on smooth, guaranteed access to physical metal through a derivatives contract during a period of rising stress, you need to think through that scenario very carefully. Fourth, if you do not own any silver and you are thinking about buying, the question is not, should I buy? The question is, can I still buy? Because when decoupling events accelerate, availability can change fast, premiums can jump, certain products can vanish, delivery times can stretch from days to weeks. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. I see a market where the paper price is being pushed around while the physical side stays firm. I see inventories trending lower, not higher. I see global demand that has not folded under pressure. Those are not conditions that typically lead to long, comfortable periods of cheap metal. They are conditions that tend to resolve with sudden repricing and tighter supply. So whatever your position is, holder, trader, buyer, observer, make your decisions based on the full picture, not just the number blinking on a screen. We are entering the final countdown. Now, let me address the elephant in the room. What happens next? Because markets like this do not drift sideways for months once the cracks are visible. They move, and they move fast. Phase 1 is where we are right now. I call it the last train. This is the window where the paper price still gives the illusion of affordability, while the physical market is already tightening underneath. Premiums are elevated, but not yet explosive. Product is available, but not unlimited. Delivery times are stretched, but not broken. It feels uncomfortable, volatile, confusing. That confusion is the opportunity, because phase 2 comes next. I call it the void. This is the period where the paper market becomes extremely unstable. Large swings, sudden spikes, sharp drops. Trading halts become more common. Rule changes become more frequent. Liquidity thins out. During this phase, availability in the physical market starts to dry up in noticeable ways. Certain products go out of stock, wait times extend. Premiums jump in steps, not pennies. People start to realize that the screen price does not guarantee access to metal. And then comes phase 3. Call it Silvergeddon. Call it a supply shock, call it a pricing reset. The name does not matter. This is where the paper market is forced to reprice aggressively to reconnect with physical reality. Shorts scramble, exchanges intervene, volatility explodes. What looked like a cheap dip in phase 1 suddenly looks like the last calm moment before a storm. In this phase, price does not rise in a polite staircase. It gaps, it surges, it overshoots. Could that happen in 24 hours? Maybe not. Could it happen in weeks or months if the stress continues to build? Absolutely. This is not a normal market cycle. This is a paradigm shift. For decades, abundant above-ground supply and deep derivatives markets kept silver trading in a relatively controlled range. But industrial demand has grown, investment demand has grown. New large discoveries have not kept pace, and the financial system supporting paper claims has become more leveraged and more complex. That combination is unstable. Some analysts argue silver should already be above prior highs once you adjust for inflation and monetary expansion. Others focus on the gold-silver ratio and see massive room for catch-up if gold remains strong. Exact targets vary. But the common theme is this. Once a true repricing begins, it does not stop at fair value. It overshoots as fear and urgency replace complacency. And remember, silver is a small market compared to global financial assets. It does not take massive capital flows to create outsized price moves when available supply is tight. That is why this moment matters. We are not watching a routine correction in a sleepy commodity. We are watching stress build in a market that underpins both monetary history and modern industry. And when those two roles collide under conditions of tightening supply and rising distrust in paper systems, outcomes can surprise even seasoned veterans. The clock is ticking. The gap between paper and physical is a signal. The volatility is a signal. The global demand is a signal. The question is not whether something changes. The question is how violently it changes when the adjustment finally comes. So, here's my final message to you. We just walked through a market where paper silver was smashed while physical silver stayed tight. We looked at widening spreads, falling exchange inventories, rising global demand, and a pricing system that is starting to fracture under stress. This is not normal volatility. This is structural pressure building beneath the surface. The time for debate is over. The time for watching is over. The paper market is cracking. The physical market is asserting itself. One is built on leverage and promises. The other is built on ounces and reality. And when those two collide, history shows us which one wins. You are not crazy for questioning the screen price. You are not overreacting for paying attention to premiums, availability, and delivery times. You are doing what responsible people do when signals start flashing red. You are thinking ahead. Because in moments like this, physical metal is not just an investment. It is insurance. It is optionality. It is financial sovereignty in a world where counterparty risk is rising and trust in paper systems is thinning out. You are holding the collateral of the real world. Do not sell. Do not let them steal your metal. Do not let them shake you out with volatility, headlines, or temporary price smashes designed to scare you into giving up a hard asset for a soft promise. The target is higher. The timeline is accelerating. The fundamentals are tightening. This is paper to atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video if you're holding physical and you're not selling. Share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this, your financial advisor won't tell you this, but I will every single day on Paper to Atoms. And here's a question for you. Leave it in the comments below. Are you holding physical or paper? Let me know in the comments. I read every single comment and I'll see you in the next update. Remember, get out of paper, get into physical. Go, go, go.